The Retirement Café Podcast, episode 43, Understanding Your State Pension.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Café Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and Accredited Later Life Advisor, Justin King.
So welcome to the Retirement Café Podcast. This week, I'm joined by Rian, and you might remember Rian from a previous episode at the Retirement Café Podcast. Rian is a trainee financial planner, and he's doing lots of exams, and we're going to quiz him today on state pensions. So welcome, Rian.
Thank you. Good to be back.
Good to see you again. So tell me, the last time I think you were on in about kind of December time for the podcast, and you've obviously done quite a lot of exams since then. Tell me what you've been up to.
Yes, so since then I've passed the first two exams. So first one looking at the ethics in the financial industry, and then on to protection. So all types of protection needs.
Right. So ethics of the financial services world. Now, a lot of people might think there aren't any ethics in the financial services world. So tell me about ethics paper. What did you get examined on?
Old and new FCA regulations. So the framework they've got in place to make sure all firms out there are giving the right kind of advice and that customers, consumers are being looked after.
Right.
So it looks at maybe where mistakes have been made, what's happening going forward, just to make sure as an industry, mistakes aren't repeated. And
what was was it a tough exam?
Yeah, so multiple choice exam, which might sound nice and easy to a lot of people, but yeah, quite a wide range of topics to cover. A bit of the unknown, but I had a good pass mark, so
great.
So overall pleased.
So did it also cover kind of things like compensation and where people go to if they're not happy with advice and that type of thing?
Yes.
Right.
Yeah,
okay.
So everything about complaints and the steps that you would undertake within your business if someone was unhappy with the service or advice they received, and what protection is in place for them.
And how people can go to the Financial Ombudsman Service and that type of thing if they're unhappy with maybe the service or the products that they've received.
Yeah, and even breaking it down to what then would happen, depending on the situation, who would investigate and what powers do they have, what compensation can they award, and the timescales and so on for that.
Great. I think a lot of people don't know this type of stuff, so maybe it's a topic for another podcast. But I know a lot of people seem to have got into trouble with some unregulated investments recently. You know, that they haven't been advised, I suppose, by an intermediary who holds the relevant tickets with the Financial Conduct Authority, and not a regulated advisors, and therefore, of course, don't have any route for compensation if they have been missold or bought something incorrectly. So it's probably good advice to people to make sure that they do take advice and make sure that the advice that they're getting is regulated advice.
Yeah, definitely, and understanding what protection you do have, because it's fairly new and it does change. So knowing how much are you covered, and how do you find out if the people you're dealing with are going to you are covered under those schemes?
Yeah, great. So the latest exam has been protection. What to the man on the street? What on earth is protection?
Yeah, so it's anything that can be put in place if something were to happen to you. And so a good example is if you're unable to work, so through ill health or if you unexpectedly died, it's putting a plan in place so that you can get financial support in some kind of way. So it may be that you want cover for your mortgage. So you've got to take out a mortgage, buy your first home. If you're unable to work or you or your partner passed away, what would happen? Would you be financially able to support yourself still? What you can do is put a policy in place that can give you some kind of cover to give you the peace of mind if something did happen, that you'd still be able to.
So this is life insurance and that type of thing.
Yeah, life insurance, critical illness, unemployment cover, all of those kind of areas.
Right. And the one piece of protection that I often see missed by, it's not so important for our retired community, but for the younger community, is income protection. You know, people think that they possibly do take out policies for death. Yeah. But actually the inability to work is just as important.
Yeah, and that was a significant section within the exam was all about income protection. Like you say, that people get very accustomed to their lifestyle based on the income they've got. So if suddenly they're told they're not able to work for various reasons, then what impact does that have on your immediate standard of living?
Yeah. And of course, if you work for a large employer, they may look after you, but they may not in this day and age. And if you are possibly self-employed or working for a small employer, they may just be reliant on statutory benefits, statutory sick pay, etc., which is not a lot.
No, when you look into it in detail and you learn how statutory sick pay works, then you realise that it's only there as a backup. It's not there to fully support you and match the standard of life you have if you're able to work.
Yeah, sure.
So in most cases, people do need something additional with that.
Yeah, good stuff. So the latest exam you're now on to is pensions.
Yes.
And this is a chunky paper, I understand.
It is. It's a very chunky paper, but rightly so. Very important subject, and a lot to learn. It looks at anything from state pension to workplace pensions, final salary pensions, and also the history of pensions. So not just where we are today in 2019, but what were the old legislation, how did the old style pensions work, all the way up to today, and how they now go working going forward. Yeah.
Now, state pensions, I know, are unbelievably important. And as you know, that one of the first things we do for any of our clients here at MFP is understand their state pension.
Yeah.
Because it's kind of an underpin to everything that we do going forward. So for people, let's say that, I can't believe there isn't anyone who doesn't actually know that there is an entitlement to a state pension, but just to go right back to the basics, what is the state pension?
So state pension, so I'd say it's a regular payment from the government when you reach a set retirement age that's based on the national insurance contributions you've made through your working life, through your adult life.
Right. So yes, we're all accustomed to paying national insurance. A lot of the times we don't actually know what it's for. So I think the first question is what do they do with the national insurance contributions that we're paying in? We now know that it's going to give us an entitlement to a state pension. But that national insurance contribution, is that invested for us? Is it saved for our future?
So in respect to state pension, so the national insurance contributions, each year that you make adequate contributions, that's a qualifying year.
Right.
So the way it works is you need to contribute a certain level for it to be a qualifying year. And then when you reach a certain number of years, that's when you become eligible to receive some sort of state pension. Currently, that is 10 qualifying years.
Right. So you've got to be in the system for 10 years.
Yeah.
And there isn't some mythical pot of money, though. They're not. It's not like if you're in a workplace pension, you get a statement every year, don't you, telling you how much you've contributed and what it's worth. You're probably in one yourself, and I know you are. Yeah, I have one myself. But the state pension doesn't work like that, does it?
No. So you are gaining the qualifying years, but that's it. It won't make a difference how much you're paying national insurance. If it's a qualifying year, that's effectively as good as it can be for that year.
Yeah.
That counts for one of your years towards earning the full state pension.
That's right. So in essence, if I was paid in for 11 years between 20 and 31 and died, my estate wouldn't receive some kind of lump sum, big lump sum for all those contributions that I'd made. No,
it's not like there's a pot of money building up. You're just contributing towards receiving your state pension.
Yeah. I remember always thinking about it when I was learning about it, as really, I'm paying my mum and dad's pension currently. Yeah. With every national insurance contribution I'm paying, the government get it and they kindly pay it out to my mum and dad.
Yeah, and that is probably the best way to look at it. Yeah. It's not put aside for your retirement, it's being used currently for people who have reached retirement.
So for the younger listeners, you can listen and you can be telling your mum and dad this weekend if they're retired that you are paying their pension, and so therefore they should look after you
and they can pay for lunch.
They can pay for lunch, or alternatively, if you are retired and you want to get back at your younger children or grandchildren, you can say, well, you are paying my pension, and thank you very much for doing that. So that's how the system works, of course. So One of the things you mentioned, there's a point in time when we're going to get this. Now, I understand, of course, that has been changing over the last few years. When I started at work in 1986, it was for me, I think my retirement age currently then was 16, was going to be 65. So that's when I was going to retire. So can I still look forward to retirement age of 65?
Well, no, unfortunately, knowing your current age, that's not going to be the case. So the state retirement age is currently 65. So the big change recently was that for men and women it was equalised. So effectively, men and women will, going forward, have the same retirement age.
Yeah, because it used to be 60, didn't it, for women, and now it's 65.
So for women, it's been a very significant change for that, both 65. However, it is going to be increasing over the next few years. So by October 2020, it's going to go from 65 to 66.
Okay, I'm in that. That's beyond me. Okay, that's not sounding good. What happened?
And then still going on. So it will go from 66 to 67 between 2026 and 2028.
Right, which I think that is where my state pension age may fall. So a couple of years extra work for me then.
Yeah, and then in fact, still going on a little bit further, up to 68 between 2037 and 2039.
Okay, right. So how do I know? Is there a way I can find out when my state pension age actually is?
Yes, so that's a very important thing you can do now. So what the government have now got available is a state pension forecast.
Right.
So you can get a statement through the government website.
Right.
So there's a gateway login, which you might have used if you do something like a tax return.
Okay.
Most government systems are using that, but you can log in and it will tell you what state pension you will receive. Key bit to remember is there'll be a big number that it will say your state pension will be. However, that will be...
And the date that I will be due to retire, presumably.
Yeah, so it will say if you contribute up to this date, this is the state pension you'll get. If you read down a little bit further, it will then say how much you've accrued to date. Right. So this is what it is at the moment, but if you work up until your retirement date, this is the state pension you'll receive. Okay,
so it'll give me my date. First of all, it'll tell me the retirement date, which could be anything between 65 and 68. Okay, so it could be a kind of a moving feast depending on the younger I am, the later retirement age it'll be. Got that. And then it'll also tell me the contributions that I've made to date.
Yep.
And how many more years I need to contribute to get the state pension.
Yeah. So it will say whether or not you've already reached the number of years you need to, or how many years you need to contribute to reach that.
Right.
And then it will go into further detail where you can look into, if you did have missing years, what you could do to complete those years and whether or not that would have an impact on the state pension you're going to receive.
So what circumstances would I have a missing year?
So if you were out of work, if you were living abroad, so there'd be probably the main reasons where you could have years where you had no contributions if your earnings weren't high enough. Right. It's another reason. So what you can do on there is see every year whether or not you made enough contributions for it to be a qualifying year.
Okay. And, you touched on things like, maybe not being in employment or, I could have been bringing up my family or, the different circumstances where I might not, just wouldn't have had the opportunity to pay national insurance. What tell me about that a bit.
You can pay national insurance contributions through employment, but there's also situations where you would get national insurance credits. Ah. So where you haven't paid it, but it's effectively paid on your behalf. Okay. So there's quite a few different reasons where that could happen, but some of the big ones would be where you're receiving job seekers allowance and you're not in education or working 15 hours or more a week. You're on statutory sick pay, right? Maternity, paternity or adoption pay, a parent with a child under 12, in receipt of carers allowance or on working tax credit or universal credit. There's a whole host of other reasons, but there's some of the most common. Yeah. In those cases, you would get a credit for that year, and that would work in the same way as if you had paid contributions. Right. That it would count towards you receiving your state pension.
And how many years do I need to contribute to get a state pension?
So we touched on that. So you need a minimum of 10 qualifying years.
Yep.
However, that doesn't necessarily mean you're then entitled to the full state pension.
Right.
So to receive that, you need 35 qualifying years, and that's to receive the full amount, which currently stands at £168.60 per week.
Okay, so every week, 52 weeks a year, £168.60. It doesn't sound a lot, but I know that if you had to buy an annuity from an insurance company to provide £160 odd, well, what's that? According to some research I remember reading from Aegon, the full value of the new state pension is, the capital value, if you were buying it as an annuity, would cost you £327,000. So it's pretty significant. So, this should be treated with a certain amount of respect, I suppose, to make sure that you are, got the right record. They've got the right record because, I suppose departments can get things wrong. It could. I know we've experienced that with people with incorrect or missing years, and they're not sure why that's the case. There's that husband and wife we've been dealing with recently who've had, the same employer, and they've got a different contribution record, which just seems absolutely crackers until we sort that out, obviously. So getting the record right, I think, must be hugely important. So 35 years. 35 years. It's a long time for a government to keep their records correct, isn't it?
Yeah, the last thing you want to be doing is, everyone like we said, everyone really knows about a state pension, but you don't want to be waiting for suddenly some money to come in, to just thinking, oh, well, it's going to happen. When I get to that age, it will just happen. You want to be a bit more proactive and see, oh, my record's up to date. What am I going to receive? Because as we said, it is a significant amount of money and it could make a big difference to your retirement. So having your record up to date and knowing as you're approaching retirement, I know that's all correct, makes all the difference.
And of course, if you've got a couple in retirement, £17,000 worth of income coming into the family home is significant, isn't it? That's not small beer. So you need to get it right. How do you get it? Do you just hit retirement age and it drops through your letterbox, or what's the way it works?
No. So as you're approaching retirement, so normally around 2 months before your retirement date, you should receive a letter letting you know there's 2 months until you're entitled to it, and that you. And
if you haven't checked your retirement age, that just could be a surprise, I suppose.
Well, exactly. You'd hope that. Yeah, that's the thing. You want to know before that letter's coming through in the post, but then at that point you do need to apply for the state pension.
Okay.
If you didn't apply, you won't be receiving it.
Right.
So
okay.
So it's on you. Someone's not going to pay it to you automatically. It's your responsibility to put in an application and be told that you're entitled to that.
Wow. Okay. And there is, if I remember rightly, there's a thing for people to look out for. There is a box on that form that people need to fill in, which is if they've been widowed or they're a widower, to actually put that down, actually tick the box to say that that's been the case, because there may be some entitlement under the previous kind of past legislation, because state pensions have changed quite dramatically over the last few years, but there is a tick that box in case there's any pension you can inherit from your late husband or wife.
Yeah. Again, previously there has been a number of different state pensions. So it's 2016 when the pension we're talking about now came in, the new state pension. Previous to that, a number of different schemes. So as you rightly say, people could be entitled to receive additional state pensions on top of the new state pension we've talked about. So getting that form filled out correctly when you send it off is really important to make sure then when you are looking into what you're entitled to, they've got up-to-date information because it could make a big difference. There could be further pension that you should be receiving. Yeah.
So just to kind of note there that under the new state pension, you don't inherit anything from your late husband or wife or civil partner, but under the old state pension, there may have been some entitlement to widow or widower's benefits from additional pensions, the additional state pension that they were eligible to. So you could easily tick that box saying you're single, which of course you are at the time, but actually the right way to tick it is to say that you're a widow or widower, and then it just makes sure that you would get an entitlement if there is an entitlement. I'm not promising anything there. Okay, so that's great. We've reached retirement age. Let's hope we get there. And we 2 months before we get this letter to say what it's going to be. That's great. Do we pay tax on this pension?
So it's not directly taxed, but it becomes part of your income.
Okay.
So it would be dependent on any other income you have. So at the moment, you've got tax-free allowance at 12,500.
Right.
So if you were only in receipt of the state pension tomorrow, then there'd be no tax to be paid, but it would be based on the total income that you receive for that tax year.
Right. Okay. So then, of course, any other additional pension will have to do a tax kind of calculation on what they're paying it. If you've got some kind of private pension arrangements, they'll deduct tax, taking into account that you're also in receipt of your state pension.
Exactly that, yeah.
And you mentioned the state pension amount. Is that fixed? Will it go up? What's the deal there?
Yeah, so at the moment, £168.60, and that increases by what's called the triple lock, which I will explain. So the triple lock guarantees the new state pension will rise by a minimum of either 2.5%, the rate of inflation, and average earnings growth, whichever is higher.
Okay. Well, that seems pretty generous.
So when we talk about how significant the state pension is, there is something in place there to make sure as cost of living increases, the state pension is increasing with it.
Yeah.
So as years go by, it should hopefully always be increasing to mean what you can buy with that amount doesn't change when you reach retirement age. At the moment, that's planned until at least the end of this Parliament.
Right. Okay. On the basis that we don't know how long this Parliament's going to last, that could not be very long. No.
So it's been a number of years the way it has been, but okay. that is how state pension is reviewed. So the government say that really the state pension should be reviewed at least with every Parliament.
Right. And on the basis that we have more and more retirees or people entering into retirement or eligibility to their state pension, even if they haven't hit retirement, that's going to be a significant cost and burden to the exchequer. So we'll have to watch this space to see what happens to the triple lock, I suppose. Yeah,
I think it's in the news quite a lot. I think people know the ageing population. So, like you say, I think it could be changed in the next few years, but it is worth looking out for.
Yeah. Okay, so we've got to check our national insurance record. We can check the age we're going to be eligible. We can check, therefore, how much we're going to get. Okay, so that all seems pretty interesting. There used to be some additional kind of pensions. There was things called SERPs and state second pension, and what's happened to all that lot?
Yeah, so as we said before 2016, there was a number of different pensions. If you had contributed to one of those schemes, so the additional state pension or the state second pension. So they're the main two. If you contribute to those, although there is now a new scheme, you won't have lost that entitlement.
Right.
You can be in receipt of the full new state pension, but also an additional payment that is known as the protected payment.
Right.
So if you contributed to one of those schemes, you should be entitled to receive a payment in respect of that and also the new state pension.
Right.
Now, those have stopped, so going forward, it is just the new state pension, but as I say, if you've contributed to those, you would still be entitled to receive that.
Okay.
The key bit is that you will not be left worse off. The government made sure when they introduced the new state pension that they will look at what you should have received with the old scheme, what you received with the new scheme. You can't have been made worse off with the introduction of the new scheme.
I can imagine there are some winners and some losers amongst all that, because I think it's a pretty difficult calculation, but probably the devil is in the detail, and each individual circumstances, I think you need to look into it, probably.
Yeah, that's one of those, it's definitely one of the more complicated areas when you look at people crossing over between old schemes and new schemes and what they should be entitled to. Very difficult to be able to work out yourself whether or not it is correct or you're worse off, but that is how it's done at the moment.
Sure. Okay. Right. Well, this is this has been particularly interesting. Is there anything that you think the listeners need to know that I haven't asked you?
So I suppose one thing that comes up fairly regularly is people that maybe are continuing to work and think,
okay,
I don't need this money at the moment.
Yeah, sure. In fact, it could even put them into a higher tax bracket because they've suddenly got more income that they weren't possibly after.
Yeah, so I think a big question comes up is, do you have to take it at that state of retirement age? Which you don't have to. You can defer it.
Right.
So, which effectively means take it at a later date. Again, that's changed quite a lot recently of what happens when you do defer it. But how it stands at the moment is you'd need to defer it for at least 9 weeks to receive any increase to your pension. It increases by 1% for every 9 weeks you defer it.
Okay.
Which that works out at just under 5.8% for every full year you defer it.
Right. Okay. So that's an interesting calculation because, of course, you've then got to work out what the tax will be paid if you take someone who's still working, that they're going to pay, and presumably they're earning over the personal allowance. So in essence, they're going to be paying everything over 12,500. They're going to be paying 20%, and everything over the higher threshold, they're going to be paying 40%. And of course, they could be even paying the higher rates of tax. So you've got to work out is the increase in the benefit and then minus the tax bill that you're going to pay when you eventually receive it. It's quite a complex calculation to work out whether it's a good value to do that.
It is, and I think that's why it's probably an unknown area. I think it's probably something that people don't realise is open to them, and then if they do, it's not straightforward to know whether or not it would be beneficial. But it is something definitely worth looking into because for some people it would work out.
Yeah,
for them.
And of course the other aspect of it, if you have forgone a year, the one guarantee in life is that your life expectancy is shortening.
Yeah, yeah, exactly.
Therefore, as you and they only pay it out until death. So of course, it's a year less that you've received the pension for, isn't it? So
that's right.
You have to weigh up that the pension is forgone. So yes, deferment definitely something worth considering. So just to summarise, then we need to establish when we're going to retire, what our state pension retirement age is. We can do that on the government website. We should establish what our kind of employment history and contribution record has been, and find out whether there's any kind of obvious mistakes or gaps. And just on that point, if we do find there are just gaps, we're not going to make 35 years because we spent 5 years traveling, or 10 years working on a cruise ship and weren't eligible for national insurance contributions. But we're now in the UK and we've got some working life ahead of us. Can we make up those years?
Yes, so you can make what's called Class 3 national insurance contributions. That effectively means it's voluntary contributions.
Right.
You can make up those missing years. However, the key point with making up missing years, it needs to be within 6 years of a tax year in which the shortfall occurred.
Okay.
Okay, so that's the key thing to be looking at is it within the last 6 years?
Right.
And again, it comes back to the point of the sooner you look at it and realise where you are as of today, even if you're 20 years from retirement, then you're in the right situation where you need to be now. You could
miss the boat, couldn't you?
Well, exactly.
Yeah, that's really quite important. Or I suppose even for people who are not maybe you could be 60 and still 7 years away from your retirement date, and it might be even worth having a part-time job that was eligible for national insurance contributions, just to make up that shortfall.
Yeah, and what's great about the pension statement you can get is it will tell you what impact that will have.
Yeah.
So you can see in monetary terms how much more money am I going to get when I get my state pension by doing this, which I think is the really important thing. Like say you've got 6 years, is it worth doing that? Well, it will tell you. You can see it's going to be £50 extra a week. Then you can weigh up, is that in my interest?
Is that good value? Yeah. And of course, one of the things that we've seen on those statements is that the statement says if you keep working up until your normal retirement age.
Yeah.
And the headline figure is, yes, you're going to get the full pension, or you're going to get this much of your pension, but it is based on you still contributing. Yeah. And of course, that can throw people. I think that's not particularly clear on those statements.
No, it's a bit like a newspaper headline is you see the headline
and if you don't
make sure you read below.
If you don't go down to the bits below, then you might miss that you've actually got to keep contributing. Great. Well, that's been brilliant. I think you've obviously learned a lot about state pensions, Ryan. I wish you good luck for your forthcoming exam in that. I'm sure there's going to be plenty of other pensions topics that we can cover. So I look forward to doing that with you. And great. Well done. Thanks for your time.
Thank you.
So that wraps up another episode of the Retirement Café Podcast, brought to you by MFP Wealth Management. To continue the conversation about topics we've discussed on the podcast, please search for the Retirement Café page on Facebook and follow us. And if you've enjoyed this conversation, please leave a review on iTunes or share with friends and family you may think who may also enjoy the podcast. So until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Café Podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.